Okay, so in the last class, we were discussing audit planning and our ongoing topic was business risk. In business risk, we have discussed uh, the first question, which was grow whole company, and I made you draft the whole answer. We drafted the complete answer and we learned that how we have to develop a point. Then we discussed a second question, which was cannoli company, in which we also drafted the answer and we learned different and we evaluated different types of risk. And our writing approach for business risk is that first we identify the risk, then we write the impact of that risk, and then at the last we give an evaluative comment. Now we are moving towards third question, which is Dove company. And I hope that by this time you have reviewed all the two questions which we have done, the examiner answers, so that you can be in a better position to develop an answer. Okay, so be connected and concentrate that how I'm writing the point. Okay, now you are a manager in the audit department of Dove and Company, responsible for the audit of Sunshine Hotel Group, which has a financial year ending 31st December 2017. The group operates a chain of luxury hotels. Now keep one thing in mind. Luxury product has an inherent risk of economic recession. Whenever we say that a business deals in a luxury product like luxury hotels, or it can be fashion products, there is always a risk that in luxury products, if the economy suffers a recession, the business will suffer the most. The reason being is that luxury products usually have high responsiveness, have high elasticity to change in income levels. And it is planning to expand the operations over the next 3 years by opening hotels in countries with increasing popular tourist destination. So, we are a manager in audit department of Dove and we are auditing Sunshine Hotel Group. So the hotel group has a luxury product. Their key subject matter is a luxury product. Their hotels face a risk of economic recession. We are reading out the question, and with passage of time, you will find some more risk also. You are about to start planning the group audit for the forthcoming year end, and the audit engagement partner has just sent the following email to you. To audit manager from John Starling, audit engagement partner. Subject audit planning, the Sunshine Hotel Group. I attended a planning meeting last week for Sunshine Hotel Group with a finance director and a representative of the group audit committee, at which we discussed the business developments during the year and plans for the future. I have provided you with my notes from this meeting, as well as some background information about the group. As I know this is the first time that you are managing the audit, I have also provided you with an extract from an email which I received this morning from the group finance director. Now we have to evaluate the business risk, 10 marks. If I divide 10 marks in ratio of 1.5 marks for each risk, so it will give me like 6 risk. 6 risk will make my 9 marks, and last 1 mark, I will cover it through trend and calculations. Okay? I have already told you that maximum you can get 2 to 3 marks for the calculation purpose. So for each risk, we will get 1.5 marks. And if we will make a trend or if we will make a calculation, we will get 0.5 marks additional for those calculations. Okay. Then part B is risk of material misstatement, which we haven't discussed yet. And then we have a part C, in which we have to discuss the email received from finance director, as it is our first topic, which is business risk. So we are majorly focusing on business risk only. Okay. Now, the group owns 20 hotels, all located in popular beachside holiday resorts. The hotel operates on all-inclusive basis, whereby a guest can consume unlimited food and drink. and take part in a variety of water sports, including scuba diving as part of their holiday. Now, if I can say that all-inclusive policy means that group has a high fixed cost, because irrespective of the number of customers, they have an all-inclusive policy. Like if there are 2 customers or 10 customers or 100 customers, they have to open all water sports, they have to open all food and drink things, they have to open all scuba diving, because they charge a single price, and in that single price, they offer customer the access to all facilities, the access to all facilities. Okay, just a minute. Okay, sorry. So we were discussing that the all-inclusive policy creates a problem that they have a high fixed cost, because at every point of time, they have to make sure that all facilities are open. Each hotel has at least 4 restaurants and a number of bars. Now, the Sunshine Hotel brand is a market leader with significant amount spent each year on marketing. So this also shows that the group has a high cost model, that they spend significant amount each year on marketing. So when we talk about such a business, it is very important that they have to manage your cash flows carefully. Why you have to manage your cash flows carefully? Because you have an all-inclusive policy. Now, at every point of time, you have to keep your facilities open. Now, you have a high marketing cost. You have to manage your cash flow, because every year you have a certain amount to be spent on marketing. The hotels are luxurious and maintained to a very high standard. So again, you can say that group has a very high maintenance cost. The group has to invest heavily on maintenance. So now there are 3 points which show us that group has a high cost model. Number 1, it has an all-inclusive policy. Number 2, it spends heavy amounts on marketing. And number 3 is it maintains a very high standard. Now, when you maintain a very high standard, your maintenance cost will be very high. Your maintenance cost will be very high, because you cannot operate in such a way that some of your facilities are not in good condition. It will affect your reputation and your brand name. And marketed as exclusive adult only luxury holiday destinations. So we can write a risk. Again, I identified it earlier also, that we have a luxury hotel, and luxury products always face an inherent risk that in times of economic recession, they will suffer the most. And your product is a luxury holiday destination. When people will not have sufficient incomes, they will obviously not be willing to spend on luxury products. When a customer book to stay in a hotel, they are charged a deposit equivalent to 20% of their cost of their stay. And a further 20% is payable 8 weeks before arrival. The remaining 60% is settled on departure. If a booking is cancelled prior to a week before a guest stay commences, then a full refund is given. But no refunds are given for cancellations within the week leading up to a guest stay. So you can also say that when you have to give full refund, you have to manage a cash reserve. Like if you are receiving the booking amount, you have to keep some cash as a reserve, that if any customer will cancel a booking, we have to give him a full refund. So in this question, you can argue that for the Sunshine Hotel Group, cash flow management, the liquidity is one of its major risks. Cash flow management or the liquidity is its major risk. Now, for this business, the cash flow management will be a significant issue for them. Okay, now coming back, The group has continued growth with revenue for the year to 31st December 2017 projected to be $125 million and profit before tax projected to be $10 million. Last year, this PBT was $9 million, so the revenue has also showed a growth and PBT has also showed a growth. According to the latest management accounts, the group total assets are currently $350 million. The Sunshine Hotel brand is not recognized as an asset in the financial position because it has been internally generated. The group has a cash of $20 million at today's date. Most of the cash is held on short-term deposit in a number of different currencies. Based on latest management accounts, the gearing ratio is 25%. So if I sum up my first page, what we have found that the company, the group deals in luxury hotels, which carries a risk of economic recession. Then the group has a very high fixed cost model, which include all-inclusive policy, which include high marketing cost spending, and a very high maintenance cost because they have to maintain themselves at a very high standard. Then group also needs to maintain a cash surplus in order to finance the refunds which it can give. Then we discussed that the group has a cash balance of $20 million, which is held in different currencies. So there is a foreign exchange exposure also, and the group gearing ratio is 25%. So if I read this first page, I have two concrete risks. One risk which I think that we can write is economic recession, which can be easily written. And the other risk is that they have a high fixed cost, they need a good cash reserve, and their cash balance is $20 million. So you can have a good argument that if a group has a high cost model, then its cash flow management and liquidity will always be a significant risk for that group. Okay. So now, moving forward, in January 2017, the group entered into an agreement with an internationally acclaimed chain, Mont Blanc, to open new restaurants in 5 most popular hotels. The agreement costed $5 million, lasts for 10 years, and allows the group to use restaurant names, adopt the menus, decorate the restaurants in the style of Mont Blanc. The cost of $5 million has been recognized within marketing expense. Now see, it is an accounting error. He should have amortized it over 10 years, but they have simply recorded it in marketing expense. So you can argue that recording in marketing expense is wrong and it should be amortized. But the point is that it is not a business risk, it will be an accounting risk. And currently we are attempting the part of business risk, not the accounting risk. The part B of the question is risk of material misstatement, but we haven't studied risk of material misstatements yet. So we will be focusing on business risk only. So if they have recorded this amount as a marketing expense, rather than amortizing it over 10 years, we cannot argue that it is a business risk, it is an accounting risk, and it will lead to a misstatement in the financial statements. Only thing which we can consider from business perspective is that they have done an outflow of $5 million, which is obviously a burden on its cash flow position, and it is one of the spending which is already made during the year. Now moving forward, part of the group strategy is to expand into new countries. Now when you go into new countries, you have exchange rate exposure. When you go into new countries, you have an exposure of laws and regulation. You can have some non-compliance issues, like if we are operating in multiple countries, we have to look around for laws of each and every country. So it can be a business risk that when you operate in other countries, when you operate in new countries, you may not have knowledge about the laws and regulations of that country, and this may ultimately lead to a non-compliance matter. Moving forward, and in July 2017, the group purchased land in 3 new locations in Farland at a cost of $75 million. Now we have invested in new lands at a cost of $75 million. There are currently no specific plan for development of these lands due to political instability in the country. Now, this was the risk which I was referring, that when you invest in new locations, you don't have knowledge about their political situation. You don't have knowledge about their laws and regulation. Now you have invested $75 million in an area, in a country where you cannot do development due to the political instability. The point is that you have stuck up your $75 million in a bad investment and you have wasted the funds. Now, in addition to Farland, an existing hotel complex was purchased from a competitor for $23 million. You invested $75 million. Now you have purchased one more hotel for $23 million, which gives us a total of $98 million investment in 1 year. The hotel complex is located in a country where local regulation prohibits private ownership and use of beaches, so the group hotel guests cannot enjoy the private and exclusive use of beaches, which is one of the group key selling point. Again, they have made a bad investment. You first of all wasted $75 million by investing in a politically unstable country, and now you have wasted $23 million in a country where your guests cannot enjoy your key selling point. For this reason, the group has not yet developed the hotel complex, and it is currently being used as a location for staff training. So there is a risk that, I will say that it's not a risk, it's a concrete information that group is a bad investor. And if they will continue to invest in this manner, soon they will run out of cash. Okay, now, all of these assets are recognized at cost as property, plant, and equipment. We don't care whether you have recognized at cost or NRV or whatever it is, because that will be the accounting issue. And currently we are writing business risk. Due to the problems with these recent acquisitions, the group is planning to invest in alternative locations. I cannot understand that what is the group's strategy. Their total asset base is of 350 million. Out of this 350 million, they have already done investments of $98 million during the year, and now they want to invest more. So you can say that group is over trading, is over investing. It is not planning and it is not looking for right strategies. On sites in new locations for $45 million budgeted. This will be funded entirely from undrawn borrowing facility. Now this will increase your gearing and therefore your exposure. And considering your bad investment ability, you will increase your problems. With the group bank, which has a fixed interest rate of 3.5% per annum, so I can argue that considering the group's bad investment ability, considering the group's past, this $45 million loan will increase group's risk by a greater extent. Okay, so till now, I have found a risk of economic recession. I have found a risk of high fixed cost because the group has all-inclusive policy, heavy marketing expenditure, high maintenance expenditure, and I have identified a risk of new countries, that when you enter new countries, you always face a risk of exchange rate exposure, you face a risk of laws and regulation. We have identified the risk of bad investment, that 75 million and then 23 million invested in a bad manner, and then we have a risk that group is taking a new loan of $23 million, which will obviously further increase its risk. Now, we are reading more. We have to write 6 risks in the question so that we can get 9 marks. Now, 2 of the group hotels are located in an area prone to hurricanes. Now, hurricane, natural disaster, it is obviously a business risk, because hurricanes, you will face loss to your assets. And unfortunately, only last week, a hurricane caused severe damage to both of these hotels. So you can say that we have suffered a loss to assets, which is obviously a business risk. Under the group hurricane guarantee scheme, customers who were staying at the hotel at the time of hurricane were transferred to other group hotel at no cost. Now, when you are transferring the customers at no cost, it is obviously increasing a burden. It will obviously increase the burden at no cost to customers. Customers with booking to stay at closed hotels have been offered a refund of their deposits or transfer their reservation to a different group hotel under the terms of the scheme. So I can say that this natural disaster will increase the cash flow problems of the company further. They will face more cash flow issues. Why? Because the 2 hotels are damaged. There will be repair expenditure. There will be no revenue during the repair period. And then you have to give refunds to the people. You have to relocate them. You have to shift their bookings. This all is an additional expenditure of the company. The hotels are closed while the necessary repair work will take 2 months at an estimated cost of $25 million. So you can argue that repair cost will further increase cash flow issues. The repair work will be covered by group insurance. Oh, good, it's insured. This means the risk will reduce, which typically pays half of the cost in advance, with the balance when the repair work is completed. So you can argue that for half of the period, our cash flow may get stuck. Because for half of the period, we have to invest on our own. Okay? Then we have a discussion. We have an email from the Group Finance Director, John Starling, Audit Engagement Partner. Now, the group's lawyer has received a letter from Ocean Protection, a multinational pressure group which aims to safeguard the marine environments. Ocean Protection is claiming that our hotel guests are causing environmental damage to delicate coral reefs and scuba diving under the supervision of the group scuba diving instructors. Now, they are arguing against scuba diving, which you remember was our key selling point. It was written above that scuba diving was the key selling point. Ocean Protection is pressing the charges against the group and alleges that our activities in breach of international environment protection legislation, which is ratified means accepted by all countries. So if this ocean protection is true, I can say that it can become a going concern matter. Because if that regulation is ratified and ocean protection has a valid claim, Now it's dangerous because if our key selling point is affected, obviously our business model will suffer a lot. Damages of $10 million are being sought. Ocean Protection suggests that this amount would be used to protect the coral reefs. Now, this $10 million will further increase our liquidity issues. Now, this is a further burden on our liquidity issues, okay? Now, this can be a seventh risk on which we can discuss. The group is keen to avoid any media attention. So I'm hoping to negotiate a lower level of payment and an agreement from Ocean Protection that they will make sure that they will not make the issue public knowledge. From an accounting point of view, we do not want to recognize a liability. Now it's an accounting risk. We don't care. We are writing a business risk currently, as disclosures will draw attention to the matter. We will account for any necessary payment when it is made, which is likely to be next year. I understand that your audit team will need to look at this issue, but I ask that you only speak to me about it and do not speak to any other employee. Also, I do not want you to contact Ocean Protection, as this could impact on our negotiations. And at the end, we have 4 professional marks. So if I review the entire question, I have some good risk. I can write like 7 risks throughout the situation. And we have identified some good points. I have not identified the small points. Like from the whole point of Ocean Protection, I only counted 1. But within it, I can write multiple risks. I can write that it is a going concern issue because they are claiming against our key selling point. And I can also write that that the claim of $10 million will increase our liquidity issues. So I have written the risks which are the major risk. I'm not entering the smaller points because I only need to write the 6 points, and that 6 points I can easily complete through through major risk. I don't need to enter the smaller points. Okay, let's write up the answer. I want you all to concentrate and learn the approach. As I always say, that this scenario will not come again. No similar question. Only thing which is important is that you need to learn the approach, that how I am developing the answer. First of all, we will draw the email so that we get the first 2 marks of professional area. Audit Manager, John Starling, Audit Planning, the Sunshine Hotel Group. Let's start. So the email will be to John Starling, Audit Engagement Partner, from Audit Manager, subject. Audit Planning, the Sunshine Hotel Group. So first of all, we will write an introduction. Now, what will be the introduction? In relation to audit planning, for the Sunshine Hotel Group, for the year ended 31st December 2017, first of all, you have to change the name of the company and then the year end. For the year ended 31st December 2017, following information is relevant for evaluation of. Read the keywords of each requirement for evaluation of. Part A, business risk. Part B, risk of material misstatement. And part C is email from finance director. Okay, so you have to change the name of company in each part, you have to change the year end, and you have to change the keywords. Rest of the format of email will always remain same. I write it in every question so that you can learn it with passage of time, that how I am writing the introduction, and this gives us the easy 2 marks. Okay, now let's start the first part, which is business risk, and it will give us 10 marks. So the first risk which we are writing is luxury product. Now again, if you remember, the approach which I used while writing the risk was, first of all, I used to identify the risk. The group faces risk of economic recession. The group faces risk of economic recession as it deals in luxury hotels. As it deals in luxury hotels. Now see, the first step is always to identify the risk. So you have identified the risk. That group faces a risk of economic recession as it deals in luxury hotels. The second step will be to write the impact of this risk. In times of economic recession, people will reduce their spending. People will reduce their spending on luxury products, most. Because you all know that luxury products have higher responsiveness. Group sales will be affected most. Group sales will be highly affected. As people may not visit luxury holiday destinations in times of recession. Obviously, if you would have been dealing in a necessity good, then your risk would not be towards economic recession, because irrespective of the recession, your good would have been sold. But as you are dealing in a luxury product, you will be the one who is affected most. Okay? Now, first of all, I have identified the risk, then I have given the impact, that if the economic recession comes, then what will happen? Now, what will be the evaluative comment? The evaluative comment can be that as a group has a very high cost model, please concentrate. The evaluative point can be that as group has a very high cost model, in times of recession, in times of falling sales, this high cost will increase the group's risk, will increase the group's exposure. As group operates at a high cost model, as group operates at a high cost model, therefore in times of recession, and falling sales, it will be difficult to survive. It will be difficult to operate or survive. Now, this increases the risk. Why this increases the risk? Already you are dealing in a luxury product. You will suffer the most in times of recession, and over and above, your cost model is very high cost model. And when you deal in a high cost model, you cannot survive with falling sales. Now see, you need to understand the approach, the technique which I'm using. That first I identify the risk, then I write the impact of that risk, and then I give an evaluative comment. Okay? Now see, another risk is liquidity management. Liquidity management. Now, how will you write the risk? First of all, we have three informations through which we have identified that liquidity management is very essential for the group. Now see, group faces a risk of running out of liquid funds. Group faces a risk of running out of liquid funds due to its high cost model, created because of all inclusive policy, number one. Number two, high marketing cost and maintenance of high standard. Now, this is the identification part, that group faces a risk of running out of liquid funds due to high cost model created because of all-inclusive policy, high marketing cost, and maintenance of high standard. Now, what will happen? If group runs out of cash, then it will not be able to spend on marketing. Then it will not be able to maintain level of marketing to support brand name. Further, its maintenance of high standard. Will also face trouble. Why it will also face trouble? Further, its maintenance of high standard will also face trouble if the group lacks liquidity. Okay? Now, first of all, I have identified the risk that group faces a risk of running out of liquid funds due to its high cost model. I have given the impact of the risk, and the impact of the risk is And the impact of the risk is that if you will run out of the cash, you will not be able to do spending on marketing. You will not be able to maintain your maintenance the spending on maintenance. Now, evaluative comment. Liquidity issue is further increased. Liquidity issue is further increased due to one-off expenditure required on hotels affected by hurricane. Insurance company will cover the expense, but half outflow will be paid at end, which may create temporary cash flow burden. Now, as your fixed cost is so high, you cannot survive if you have lesser liquid funds. A temporary cash flow problem. Now see, I'm repeating it again. Please concentrate. The first risk was that as it is a luxury product, you face a risk of economic recession. The second risk is liquidity management. The group has a very high cost model. So, group has to make sure that it always has liquid funds. And if it will run out of cash, it will obviously not be able to spend on marketing. It will not be able to spend on maintenance. And this one-off accident has obviously increased your liquidity issue. Okay, just a minute. Okay, so we have written a risk of liquidity management, that it is very important for Sunshine Group to concentrate on liquidity management, and this issue is further increased due to a fact that they have to face a repair expenditure during the year. So now, moving forward, the group has a strategy to expand into new countries. So let's talk about this, that what will be the risk in it. Now, first of all, we have to identify the risk, new countries, operation in new countries, exposure to risk of non-compliance, exposure to risk of non-compliance, and exchange rate exist. Due to group's strategy, to operate in new countries. Okay, so now first of all, you have identified the risk that there is an exposure of non-compliance. Why? Because you have a strategy to operate in new countries. Now, what will be the evaluation of this risk? Now, group has to incur a high cost in monitoring laws and regulation of different countries. in laws and regulation of different countries. In case of non-compliance, it may face penalties and suspension of license. In case of non-compliance, it may face penalties and suspension of license. Okay, so we have identified the risk and we have written the impact of this risk. Now, what can be an evaluative comment? Now, instead of writing an evaluative comment here, I will give a reference that during the year, this risk was materialized when we invested $23 million in a country where local legislation prohibit the ownership of private beaches. Now, instead of writing an evaluative comment, I'm writing a point here that there is an issue. The risk has materialized during the year as the group failed to ensure compliance during the year, and its $23 million are stuck in a country. Now, this risk materialized during the year. When did it materialize? This risk materialized during the year when $23 million were negligently invested in a country, where group cannot practice its key selling point, due to local regulation. Its key selling point due to local regulation. Okay, so now, first of all, I have identified the risk. Exposure to risk of non-compliance and exchange rate exists. I have written an impact that group has to incur a high cost in monitoring laws and regulation. And I have written that in case of non-compliance, you may face a penalty and a suspension also. And then we have given a reference, or we can say an evaluative comment, that you have materialized this risk when $23 million were negligently invested without reviewing the local law, and ultimately the total was not developed because we cannot practice our key selling point. So if you concentrate on my approach, I use 3 colors so that you can understand each part of the question. You can understand that how I am developing the point. First of all, I identify the risk, then I refer its impact, and then I give an evaluative comment. Okay, now, the 4th risk was 2 bad investments made during the year. The first bad investment was of $75 million in foreign land where there is political instability, and the other bad investment was of $23 million where there was a local regulation issue. So whenever you make bad investment, this shows that you will soon run out of cash, number 1, and your investor will obviously get annoyed because you are not generating any return on those investments. Now, 2 investments made during the year, of $98 million in total failed to generate any economic benefit any economic benefit as in both locations, hotels were not developed. In both locations, the hotels were not developed. Why they were not developed? Because at one place, there was political instability. And in the second place, there was a local regulation issue. So two investments made during the year of $98 million in total failed to generate an economic benefit, as in both locations, hotels were not developed. This means that how much percentage of assets? 98 million divided by 350 million is our total asset base. This means that 28% of assets is stuck in wrong investments. Now, investors will get demotivated. Investors will get demotivated to invest in the group as return percentage of investment will fall. Obviously, when you are investing in wrong places, your return percentage will fall. Further, these investments may lead to capital losses at time of sale. Due to political and legal issues there. In those areas. So now if you see, I didn't use 3 colors in this risk. Obviously, it was not because I was feeling lazy. It was due to a fact that if you read this risk, now this risk was a general discussion-based risk that I have identified that group has made a bad investment. I have discussed that it represents such a big percentage of the assets, and I have discussed 2 impacts of those risks. So there are some risks, there will be some time that you will feel that I don't follow the format given by sir, and I just want to write it on overall basis. So you can do this. We did this in last question also, while we were writing the risk of liquidity. Okay, remember? And I told you at that time also that it can happen in 1 or 2 risks in a question that you don't follow the format and you will write it on your own. So if you are doing so, it's allowed as far as it covers the impact or the evaluation, at least in detail. Okay? So the first risk was that the group deals in luxury product. The second risk was liquidity. The third risk was that we are entering new countries. The fourth risk was bad investment, 2 bad investments made during the year. And now obviously the fifth one, the group is planning to take a new loan of $45 million at a rate of 3.5% per annum. So if I calculate the interest, $45 million into 3.5, this gives me $1.5 million a year. You are taking a loan of $45 million, which will create a further burden of interest cost of $1.5 million, which is almost 15% of your profits. As your profits are $10 million And if you'll take this loan, you will face an additional interest cost burden. Already you have such a high fixed cost, you are taking one more loan, which will further increase your interest burden, your fixed cost burden. And considering the bad investment experience of the group, the risk is very high that this time again the group will invest in bad areas and ultimately the bank will create problems. So, new loan, groups plan to take a new loan, of $45 million. Groups plan to take a new loan of $45 million will increase its risk due to fixed interest burden. New interest cost of 45 million into 3.5% of $1.5 million represents 15% of PBT. It will further increase group cash flow problems. As it will be an addition to existing high fixed cost of group. Already you have such a high fixed cost of group. Now, so group's plan to take a new loan of 45 million will increase its risk due to fixed interest burden. New interest cost of 45 million into 3.5% is $1.5 million. It will further increase group cash problems as it will be in addition to existing high fixed cost of the group. Okay, so now we have identified the risk and we have discussed the fact that there will be a new interest cost and it will increase the fixed cost burden, and obviously the group already has a very high fixed cost. So if I ask you to give an evaluative comment, what will be your evaluative comment? If I would be writing an evaluative comment, I would have written that considering the group's bad investment habit, the bad investment experience, it may invest this $45 million in a bad manner. And this time it's not your funds. This time these are the funds of the bank and they will create problems for you. Considering group's bad investment experience, risk is high. Group may invest in a bad venture, which will increase problems, as group will not be able to pay interest cost. Okay. So the new loan will obviously increase the growth problems. The interest cost, which is 15% of profits, will obviously increase your problems. And considering your bad investment habit, your bad investment experience, it will surely hit you. Okay, so we have given an evaluative comment also. So the first risk was luxury product, then liquidity management is a very important risk for the group. New countries, increase your exposure. Bad investment, obviously, you are running out of the cash and now the investors will not be motivated to invest. And then we have new loans. Moving towards the last risk, the hurricane. Obviously, the natural disaster has caused the losses. Then for 2 months, our hotels will remain closed. Then we have to invest on repair also. So, hurricanes affecting 2 of the group hotels. 2 of the group hotels will result in liquidity issues for the group. Why liquidity issues? Group will not be able to generate any revenue, for 2 months, as these hotels will remain closed. For repair work. Further, due to group hurricane guarantee scheme, due to group's hurricane guarantee scheme, cash outflows will arise in relocating customers and in refunds. Okay, so first of all, you have identified the risk that it will obviously affect our liquidity in a bad manner. And then you discuss that you will not be able to generate any revenue, plus you have to give refunds. Your hurricane guarantee scheme also creates a burden because you have to relocate people, you have to give refunds. Okay, then the evaluative point. The problems will increase further as insurance company will only give half of repair cost at start. Group has to invest half of its funds. Until completion. Now see, this evaluation was also used earlier and we have used it again also. So it's allowed. It's not an issue. Like if you are using an evaluation in 1 or 2 places, you can do it because Earlier, we referred it during the liquidity management, and here we are referring it that due to natural disaster, these are the problems which were created for the group. Okay. Now, you still have one more point of ocean protection, but obviously we are not writing it, but because we are completed with our 6th risk. But if I give you a brief approach that how you will write it, then you can write it that the claim of the ocean protection has created a going concern issue for the group. Why it has created a going concern issue of the group? Because if the claim of the ocean protection is right, then the group will have to seize its key selling point of scuba diving, because it is claimed that it is illegal due to international regulation ratified by majority of countries. Okay, so if it's true, you have to seize your key selling point, which is obviously a going concern issue. And then you can argue that the problems are further increased because the group also lacks sufficient cash position to pay the amount of claim of $10 million. You only have $20 million in your bank, as we identified it here, that we only have $20 million in the bank, and we already have a high fixed cost business. We have to pay the high repair cost of the hotel affected by the hurricane, and obviously if we pay them $10 million, we will be in severe liquidity issues. So if you review my answer, I always say that, see, every question is a different scenario. The points will not repeat. But what you need to learn is that you need to develop the approach, like how to identify the risk, how to write its impact, and how to develop an evaluative comment. Okay? So again, as I told you in the previous question of Cannoli company also, that when you write a risk, whenever you write a risk, you are done with my with practice with me, always read examiner answer so that you will have a more better learning of the approach which examiner uses, and you can have some more points also. So, third question, in which the first issue was that they were dealing in a luxury product. Second issue was that liquidity management was essential for them. Third issue was that their strategy to operate in new countries will increase the problems for them. Fourth was a bad investment by them. Fifth was they are planning to take a loan, which will increase further problems due to fixed interest cost. And the sixth issue was a natural disaster, which has damaged their and the hurricane guarantee forces them to invest, forces them to force them to give. Despite of bringing repair, still they will face issues because it's to be paid by the money itself while the repair work. Okay, this is the third question which I have done. If you would have been reading the examiner answers, which I hope that people are reading the examiner answers, then I think that with the passage of time you will learn the ability that how to develop a point. Okay. I'm giving you one more question. Which I want you all to read as a Huntsman Company. Just a minute. Copy. And I'm adding these pages here, but obviously I'm removing the annotations so that you people can do this question from the very start. So this is a question of business risk, which is of 50 marks, or the audit planning, which is of 50 marks. Business risk is of 8 marks. Now, this is the most latest question of business risk. I want you all to first complete the 3 questions which you have done with me. Read the examiner answers, read my answers, develop the learning points, and then read this 4th question. We will do this 4th question in our next class, but I hope that you people will first attempt these questions on your own. Okay? If you have any queries, you can ask me on my WhatsApp number. Thank you.